The notion of taxing billionaires on their company shares, particularly when these shares are used as collateral for loans, is gaining traction in discussions around wealth inequality and the way the ultra-rich navigate the tax system. This idea is rooted in a desire to close loopholes that the wealthy use to amass incredible fortunes without triggering significant taxable events. The idea is simple. If billionaires use their shares as collateral to access cash, should that count as a taxable realization of value? This article unpacks the complexities and arguments surrounding taxing billionaires on their company shares, examining perspectives from various sides of the debate and exploring how such a tax could work in practice. The crux of the argument for taxing billionaires' shares as collateral lies in the concept of collateralized loans. Billionaires often use their equity in companies they control to take out massive loans, enabling them to unlock vast sums of money without actually selling their shares. This technique allows them to continue to benefit from the potential appreciation of the stock while also avoiding the taxable event that would be triggered by an outright sale. The use of shares as collateral is not unique to billionaires. Many people take out loans using their homes or other assets as collateral. For example, a homeowner might take out a home equity line of credit using their property as security. The difference, however, is scale. When billionaires leverage their company shares, they are often accessing hundreds of millions or even billions of dollars, allowing them to effectively finance a lavish lifestyle or invest further without having to pay taxes on the income from selling assets. Supporters of taxing collateralized shares argue that this should be treated as a realization of value. After all, when someone borrows against their shares, they are effectively converting an otherwise illiquid asset into liquidity. As some have pointed out, if shares are being used as collateral, there is a sense in which this is a realized gain, even if the shares aren't directly sold. The value of those shares is being actively used to obtain something of immediate worth, a large sum of cash. Moreover, proponents argue that the current system allows the wealthy to benefit from their assets without contributing their fair share of taxes. In a typical scenario, a billionaire might use shares as collateral to borrow money, spend that money, and then repay the loan using funds generated through various untaxed means, all without having to sell or lose control of their shares. In this way, the ultra-wealthy can live extraordinarily well without triggering taxable events like the rest of the population must. On the other side of the debate, skeptics of taxing collateralized shares argue that such a tax could have unintended consequences for ordinary individuals. Some argue that taxing loans secured by assets could impact people who take out home equity loans or margin loans on their investments. The principle of taxing collateral might end up being applied broadly, potentially leading to taxes on common practices such as using a car or home as collateral for a loan. Critics also point out that collateral is not a gain, it is a guarantee for a loan. If the borrower defaults, the collateral can be seized, but until that point, the asset itself has not been sold or converted into income. The debate also touches on practical concerns such as how to value assets used as collateral. If shares are used to secure a loan, but the value of those shares fluctuates, how would the tax system account for such changes? This complexity makes it difficult to implement a straightforward tax policy on collateralized shares. Another argument against taxing collateralized shares is that it could discourage investment and economic growth. A levy on collateral could be seen as anti-growth and anti-business. Wealthy individuals and companies often use loans to finance new ventures, expand their businesses, or invest in innovation. Taxing the use of shares as collateral might reduce their willingness to take risks and invest in the economy, ultimately slowing down growth and innovation. There are also concerns about double taxation. If a billionaire takes out a loan using shares as collateral and then later sells those shares, they would already have paid taxes on the loan amount if collateralizing shares were considered a taxable event. This could lead to a scenario where the same value is taxed twice, once when the loan is taken out and again when the shares are sold. This kind of double taxation seems inherently unfair and could create a significant disincentive for using assets as collateral. Some have proposed a potential solution, allowing taxpayers to offset future realized gains with taxes paid on collateralized loans. For example, if someone pays taxes on the value of shares used as collateral and later sells those shares, they could receive a credit for the taxes already paid. This approach could help address concerns about double taxation while still ensuring that the wealthy contribute taxes when they leverage their assets for cash. There are also proposals for more targeted approaches to taxing collateralized shares, such as only taxing loans above a certain threshold excluding primary residence mortgages. This approach would ensure that ordinary people using their homes or smaller assets as collateral would not be affected, while still targeting the ultra-wealthy who use massive loans to avoid paying taxes on their assets. Another concept that has been introduced is a leveraged gains tax, where the value of shares used as collateral would be treated as a realization event, and taxes would be paid on the gains up to that point. If the value of the shares increased further, additional taxes would only be paid on the new gains. This concept attempts to strike a balance between recognizing the value unlocked through collateralized loans and avoiding overly punitive taxation on future appreciation. The debate over taxing collateralized shares is ultimately part of a larger conversation about wealth inequality and the tax code's role in addressing it. Some argue that the argument over unrealized gains and collateralized loans can be a distraction from the broader issue, the need to distribute wealth more fairly. While taxing the ultra-wealthy may not solve all problems related to inequality, it is seen by many as a step toward ensuring that those who have benefited most from the economic system contribute their fair share. However, focusing on the technicalities of taxing collateralized shares may obscure the more immediate and achievable goal of increasing taxes on the ultra-wealthy in general. Instead of getting bogged down in complex policy details, some argue that policymakers should focus on more straightforward ways to ensure that billionaires pay more in taxes, such as closing loopholes and raising capital gains taxes. One of the challenges in implementing a tax on collateralized shares is the potential for unintended consequences. Conflating unrealized gains with income could lead to complications. For example, if the value of the shares used as collateral drops significantly, the borrower could be left with a tax bill based on a value that no longer exists. This kind of volatility could make it difficult for taxpayers to plan and could lead to situations where people are forced to sell assets at a loss just to cover their tax obligations. Another compromise could be to apply a lower tax rate such as 5% or 8% when shares are used as collateral. This approach would recognize the value being unlocked through the loan while not imposing an overly burdensome tax rate that could discourage economic activity. Additionally, this kind of tax could serve as a penalty for not engaging in market activities by selling the shares, encouraging more liquidity in the market. The concept of taxing collateralized shares raises important questions about fairness, economic growth, and the role of the tax system in addressing wealth inequality. While there is no easy answer, the discussion highlights the need for nuanced policy solutions that balance the desire to tax the ultra-wealthy more effectively with the potential economic consequences of doing so. One potential path forward could involve a combination of targeted taxes on collateralized shares above a certain threshold, lower tax rates for these transactions, and credits for future realized gains. Such an approach could help ensure that billionaires contribute their fair share without stifling economic growth or creating undue complexity for taxpayers. In conclusion, the idea of taxing billionaires on their company shares when used as collateral is a thought-provoking proposal that has both supporters and detractors. It raises fundamental questions about how we value assets, what constitutes a taxable event, and how we ensure fairness in the tax system. As the debate continues, it will be crucial for policymakers to consider the potential impacts on both the wealthy and the broader economy. striving for solutions that promote fairness without hindering growth and innovation.